Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in, take a look, see what's going on today. If you want to follow me, it's at @Finance, and if you want to join our community, finding-value.com, where I dive deeper into all these topics, subjects, sectors, looking for investment opportunities, sharing those opportunities with everyone in the community. I do this through Q&A sessions on the weekend, either on Saturday or Sunday. And I also share midweek updates for the companies that we follow, or at least that I follow, and give you opportunities of the setups that are in the companies that I follow. If that's interesting to you, please sign up. Special the coupon code if you want a discount. It's 50% off the first month only on a monthly membership and a larger discount on the yearly membership. And you can always swap from a monthly to a yearly for those further savings if you'd like to. Starting with the Nas, he says, someone got to teach this guy three basic things. And he's responding to this person writing this article. He says, unwinding production cuts has nothing to do with OPEC plus. It is the group of 8 who made the 2.2 million barrels per day voluntary cuts, not OPEC plus. Raising production ceilings, which are quotas, is one thing. Raising production is another. So they raised quotas, but actually didn't raise production as much as the quota. Production is one thing. Supply that affects global oil markets is another. So what people think and what the narrative is that if they raise a production quota, that production, the actual supply, will increase. Another thing that they're doing is that if production does go up, well, that means that it's going to impact or affect the global oil markets in terms of exportable oil. During the summer months, a lot of the Middle Eastern countries burn oil for electricity demands. So they can increase production, but if it never leaves the country, did it impact the global oil market? Well, no, it didn't. And that's what I think he's making the case. He's like, well, these are quotas, not production. And production, even though it may go up, doesn't mean it's exportable oil, which impacts global markets. Coming down, we've got the Kobayashi letter. The secular bull market that began in 2009 is now 16 years old. Will it end like 1968 or 2000? And those were both beginning of bull markets in commodities. So by him stating this, basically he's on board with the commodity bull market and then the end of the bull market in S&P 500 NASDAQ. The 1982 to 2000 cycle ended with a 114% rally into the dot-com bubble before crashing. On the other hand, the 1949 to 1968 cycle ended with a series of smaller peaks and deeper pullbacks. As seen below, today's market is tracking more like the 1960s pattern than the late 1990s blow-off pattern. The CAPE model suggests returns could still accelerate over the next few years before the peak. Both historical analogs imply more highs ahead before the secular wave ends. This bull run is incredibly strong. So you can go back and you can look, you can see this is a bull run here. We had a bottom of like 49. Well, I guess the absolute bottom was in the 30s. We had a big bull run here all the way up, and then it kind of rounded over in 1968, where we had a sideways chop during that commodity bull market. That ended in early 1973 was the ultimate bottom, but 82 is when we started to really make progress in the next bull market. So we had the next big bull market, which basically peaked in the year 2000, and then we went sideways from 2000 to 2008, which is another sideways chop. I'm expecting another sideways chop. I don't know when it will start. All I know is that we are expensive in that area. So when I go and I look for investments, I want to buy value. I want to buy a deal. I don't go out and I don't overpay, hoping that someone else will overpay more than what I did. So I look for value, and value is what gives you that margin of safety. So the margin of safety is over in the commodity space and precious metals. The more risky plays, because of valuation, are all over in the Nasdaq, AI, and some of the S&P 500 companies are also in that camp. So although we could still go higher, it is possible. I would venture to say that it's not a logical idea or conclusion to go invest in companies and hoping for a peak. Now, the technical analysis guys, they're going to say I'm wrong. They're going to say, hey, if something's going up, we should be going up and invested in that until the end. And I would say that that's where danger could occur, depending on how you're approaching it and what you're looking at. Some people will say that they'll trade anything, that they will trade anything. I'm not I'm not that person. I will not trade anything. If someone said, "Will you trade a piece of dog crap higher?" and to me, I wouldn't. The risk is too high. So some people might say that they'll trade anything and that the chart matters the most. They'll wait for a breakout, they'll buy the breakout, and then ride it on higher. Now, if the company is fraudulent and it has absolutely no value, I don't want to be associated with it. I don't want to be in it. And that, I think, is the difference. I'm more of a hybrid guy. I want to know what I own. I want it to be of good value. I want it to be a good company. I don't want to own dog crap wrapped in some sort of narrative just because it's going higher, then I'm going to go in and go buy it. That's not me. I don't want that. I want the confluence between the fundamentals and the technicals, and I want to buy something that is, at least in the beginning, undervalued and a good deal. The ape of Gold Street, so SILJ divided by silver, and I shared this one yesterday, a ratio chart. He says this is the only chart that matters if you want to make money. It's the one Rick Rule is watching before he goes to sleep. And SILJ, which is the small junior companies in silver ETF, divided by silver itself, and you can see the big move that we had in 2016. I actually played this move. This was like, I think it was in the spring or summer of that year. And over the summer, it just ripped. I did like a 3-4x in a matter of months. Months. Yes, months. You heard me right, not years, months. In the companies that I put in there. There were other opportunities in 2016. There were some iron ore opportunities and some copper companies that were squeezing up into wedges, falling wedges. First Majestic had a falling wedge at this point, and that was one of the companies that I hit up pretty good. We're in a similar situation right now where we kind of squeezed up. We've broken through that downtrend. We're doing a back test here. So again, he says above the red line should be fun. 9-year downtrend, breakout, retest, continuation. And then he's got load the truck in that green zone. And that's exactly what I did. I loaded the truck. I didn't load the truck with everything. Again, I don't put all my eggs in one basket. And I don't make statements like this is the only chart that matters. It's not the only chart that matters. it's one of the sectors that I like, and it's one of the charts I'm watching, and it's one of the areas I want to be exposed to. It's not everything, because that's where people can get hurt, is when you put everything in one area. So yes, I'm watching this. Yes, it looks absolutely fantastic. There are still some opportunities in the silver space, but I'll tell you this, that they're becoming fewer and fewer as prices go up. The opportunity, the asymmetry gets impacted. And as the asymmetry becomes less and your risk goes up as your reward goes down, your risk reward situation isn't as favorable. So the whole name of this game, guys, I'll just lay it out here. The whole name of the game is to control risk with your entry point. Your entry point and where you buy an asset is your risk. So let me say this differently. All right. When you look at an asset, and let's say the fair value, and we're just going to make this up. Let's just say the fair value of an asset is $50 of whatever the asset is. It's 50 bucks. 50 bucks per share, $50 per pound, whatever it is. It doesn't matter. If you're looking at that asset and you have an ability to buy it at extreme undervaluation, let's say it's $10. $10 of whatever unit of measure that thing is, and the fair value is 50. Are you getting a good deal? The answer is yes, unequivocally. It's yes. Does it mean it will go up immediately? It doesn't mean it will go up immediately. It means that you're most likely buying it in an out of favor market condition where everybody hates it. You're still getting a good deal, and it could still go to $7 instead of 10. But you're still getting a deal, and then you wait for those conditions to change. Now, in the future, the market conditions change, and I can't tell you the time frame of it, and it starts going up. It goes up, 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 up. All of a sudden, it's at 25, 35, 50. Now people are getting interested in it because the price is going up. You bought it at 10, maybe it bottomed at 8 or 7, and it's rocketing past 50. Everyone's telling you, how come you don't buy more at 60? And you said, well, the fair value is at 50. Historically, 50 is a good price. And now you're at 60. Your risk is up, your reward is down. And although it could still go up, it doesn't make logical sense to buy it because you're paying more than what the asset is worth. And that's what the risk is. It's people running around, not knowing anything about the value of anything, and just chasing price. Now, I'm not saying that about silver. This is still a very good setup. Don't get me wrong. But people get interested when things go up. It's human nature. It's a shiny object or a loud noise where humans want to go investigate. You know how girls get? They have something real shiny. Oh, it's shiny, and it's got a nice big rock on their hand. And then they go stare at the rock that other people wear on their hands. It's shiny. The same thing is for males in the stock market. Oh, look, it's going up. Oh, it's going to continue to go up. What's the risk? I don't know. It's going up. Your risk is what you pay. And that's how you handle your risk. It's what you pay for an asset. It's better to be paying way under the fair value of that asset. Wall Street Apes. American breaks down how much it now costs to live in Southern California per month. So I used to live in Southern California way back in the day. It's been probably 20 years or so. So they bought a home for $625,000. Her monthly payment is $5,082 a month. Jesus, that is a lot. Um, so the one thing I'm just going to talk about this from the perspective of people and what I hear them say, and then my experience and what I try to do. Because I want to make money. I want to not have to work a 9 to 5. I want to do all that stuff where I'm free. So this person bought a $625,000 house. Obviously, they didn't put a huge down payment because their monthly payment is $5,082 a month. I would never do that. I would put money down. If I were to buy a $625,000 house, I'd put 500,000 down. Now, some people would say, I don't have that money. Well, then don't buy the house. I mean, this is a big payment, guys. That is big. My payment is a fraction of that. And I did that on purpose. And my house cost, I mean, it was less than 625, but I also bought it when the market was down. And that's the importance of understanding the cycle. It's also important to make sure that you can refinance your house with a low interest rate if you can do that. And that was a large cornerstone of what I was trying to do as I was building wealth. I was trying to lock in my costs as low as possible. And my largest cost at that time was my home. It was my mortgage. So this is the largest cost here, $5,082 a month. And I wouldn't sign up for that. I'd put a larger down payment. If you can't get a larger down payment, you got to look at renting. If renting isn't viable, I would move. I would get the heck out of there. Electric bill is $400.29 a month. Jesus. You know what mine is? It's in the 40s. 40s, $50 a month is what I pay for electricity, at least in the summer. It's about $100 in the winter. $100 in the winter because my heat kicks on. And then in the summer, I'm paying, 40, 50 bucks. It could be more depending on if people are here and they've got TVs or something going on. The gas bill, natural gas bill is $119. Now that's what my natural gas bill is in the winter. My summer is literally super, super low. I mean, it's almost zero, but there's a little bit that leaks out through the water heater. I have natural gas water heating. Frontier Internet's $89.99. Mine's a little bit less than that. I think I pay 70 bucks a month. Waste Management, 138. It's for 3 months, so 1 month comes out to 46 bucks. Mine's a little bit less than that and I pay on a 3-month basis too. The work van cost is $1,200 a month. My Lord, that's expensive. Personal truck is $1,200 a month. Where are you getting these? I mean, that is unacceptable. $1,200 a month, really, for a personal truck? A motorcycle, $450 a month? What do you don't? I mean, did you put zero down and you just purchase these things by borrowing money? That is not what you want to do. You know what my personal car is a month? It's zero. You know what my work van cost is? Zero. You know what my motorcycle cost is? Zero. You know what my vehicle insurance is a month? A little over $100 a month if you were to do it on a monthly. I paid in a yearly and I get a discount. I pinch pennies wherever I can. Now, here's the thing. Is that person's quality of life better than mine? I highly doubt it. Is their truck better than mine? Could be. I don't really give a crap. So if I don't have these, do you know what that is? Investment, 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 investment. I cut their investment. I pay a fifth to a tenth of this investment money. Electric bill, a fourth of it, investment money. Gas bill, 1/10 of it, investment money. That's where you make all your money, guys. You make your money by making decisions where you maximize the delta between your income and your costs, and then you invest it. And then the better you get at investing it, the more money you can make to get out of this rat race, so to speak. I mean, a grand total of about $10,000 a month to live in Southern California, it doesn't cost that much. So I lived in Central California for a little while, and I knew the owner of one of the houses that I was renting, and I was in college. She purchased the house for $200,000 in 1999. Her mortgage would have been nothing. And I think she paid probably almost cash for the whole thing. And you know what else is really cool about California? This is what's cool about it. They can't raise your property taxes very quickly. I don't know what it is, a law or something they have in there where it can only increase by like 2% a year. She's still paying a super low amount because she still owns all the houses. She bought 3 houses in 99. Probably knew about the real estate cycle. It says 500 if you remove the extra 500 they pay on the home mortgage. For reference, her home was purchased for 625. The average home price in Southern California has risen to 875, meaning your new average mortgage payment would be about 6,000 bucks. Because interest rates are so high, after 30 years you would have paid 2.2 million for your home. So this is one of the reasons why I don't live in California. And you know what else they do? They hit you on the front side of income tax too. So your income gets taxed more. So I went somewhere that has less income taxes, state taxes, and a much lower cost of living. And then I took my largest cost and locked it in at a very low rate. So compounding quality, great investors see the big picture. Here's 15 visuals to show you how. How long does it take to double your money? So 2%, 35 years. 4%, 17.7. 10%, it takes 7 years to double your money. At 20%, it takes 3.8 years to double your money. Now, I compounded my money for a 5-year period, and I'm going to exclude the past 2 years. The past 2 years, I've been more flattish than those other ones. But during those 5 years, which include 2019, 2020, 21, 22, 23, I compounded at 43% annual return. 43%. My entire portfolio, which is off this chart for 5 years. Now, I've gone sideways a little bit in 2024. 2025 is turning out to be a very good year. But 2024 was a sideways year. I didn't make it nearly the same returns as I had in other ones. And that's only looking at my paper accounts, my equities. I know that gold, silver, platinum did well in 2024. The combination of my holdings there. And then they're doing fantastic, absolutely fantastic in 2025. The physical metals side and the equities portfolios. And I haven't added them all up, but some of them are up quite a bit. Others are lagging a little bit depending on the mix in the portfolio and the portfolio that you're looking at. Coming down to here, the magic of buybacks. And this is something that I do look at and look for. So this is shares bought back. And this is your return without a change in earnings or PE multiple. So if you buy back 50%, you get a 2 times return, a 2x. A 67% is a 3x, 80% is a 5x, 90% of your shares bought back is 10x, 95 is 20, 98 is 50, and 99% is 100. He says it only starts becoming magical after 80%. Robust earnings growth and multiple expansion delivers huge home runs. So what we're doing on the website and what I'm doing with my portfolio is I'm focusing on a lot of companies that do share buybacks. And they're not just buying back a little bit. They're buying back about, I'm going to say between 5 and 15% of their shares per year. Now this is going to add up over time, and it is dependent on their cash flow. So if the commodity goes up or their day rate goes up or whatever it is, they can increase their share buybacks as their free cash flow increases. This also puts a bid underneath the stock price. And that bid makes it a little bit easier to hold. It dampens some of the volatility to the downside as they continually buy back shares. I would say half of my portfolio is like this. Maybe, yeah, about half, maybe a little less than half. There's some companies that pay dividends and some pay, they buy back shares. This is the most efficient way of returning capital back to shareholders is through share buybacks. Investing cheat sheet, I'm not really going to go through this. There's a lot on there. The S&P 500 number of large down days, you can see that. And you can see the 1930s was very rough for that. And you can see it's kind of more dampened. I'd say after 1960, a little bit more dampened after that. The value of compound interest by visual capital list. So the value of compound interest as it comes up, boom, 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 as it goes. Annual GDP growth. You can see the different countries. Investing, NBA, and I'm not going to go over that, but these are just books that you can read. Think like a farmer, and I'm not going to go over all those. The 80-20 principle, 80% eating is health, 20% is exercising. 80% of wealth building is habits, 20% is math. Talking, 80% listening, 20% speaking. Learning, 80% understanding, 20% reading, and so on. How to make an investment plan. Define your goal, long-term retirement saving. Know your time horizon. How many years can you stay invested? Choose your strategy. Monthly investment in index funds. Stay diversified across regions, sectors, asset types. Stick to it, even during crashes. CAGR, so that's compounded annual growth rate, explained. How Peter Lynch selects stocks, and there's some of the metrics that he looks at. 10 principles from Joel Greenblatt. I'm not going to go over all those. Compounding, saving $8 per day is $3,000 per year. Reading 20 pages per day is 30 books per year. Walking 10,000 steps per day is 70 marathons per year. Never underestimate the power of small habits. And then 21 lessons from Naval Ravikant. Who's that guy? Coming back. The market hates oil. That's why I'm long. I'm not an oil perma-bull. In fact, I'm bullish on all forms of baseload energy, excluding hydro, and have investments across these sectors. Right now, I believe we have a unique setup. The only real source of global supply growth, which is U.S. shale, particularly the Permian, is approaching a plateau or even decline, just like every other major shale basin. The view isn't mainstream. Instead, people are worried about demand. I'm not. Will demand drop during recession? Absolutely. Well, hey, that's actually not a correct statement. The demand only drops during like major blowout deleveraging events. 2008, yes. In the 1990 and 2000 pullbacks, it impacted demand growth, but it actually didn't drop. So the growth dropped, not the actual demand. So it's not absolutely. That is not an absolutely there. Will it be temporary? Of course. Let's look back. The worst demand shock in modern history happened during the lockdowns, and that's kind of that's more of an anomaly. The lockdown demand dropped 8%, oil prices even went negative, and then the big move higher. In other words, demand takes care of itself. Meanwhile, since the 2020 bottom, oil and gas equities have outperformed both the S&P and the Nasdaq, despite the tailwind of the AI bubble, bearish sentiment towards oil and gas, record low hedge fund positioning in energy. Energy's weighting in the S&P are near all-time lows. What I'm saying is simple. We're early. Yeah, we are early. And this is a bottom. We went through a bottom in 2020 and we're starting to come out of it, and it's just taking time. What it is. The S&P 500 is up 10% for the year. Guess what's up 72% and no one cares? The Van Eck Junior Gold Miners ETF. 72% this year. I didn't even realize it. I'm in SILJ with a big chunk of money. GDXJ, which is this, up 72%. In fact, one of my guys I used to work with, he bought a whole bunch of this back some years ago. This was a couple of years ago. He's still riding it. I'm like, dude, just ride this thing. It's going way higher. Emerging market equities ex China. Look at that breakout. Clear as day. You want to get it before this breaks out. So when you see these lows come up like this, that's when you know. This is wave one here, and now we're in wave three ripping. Big move. Here's another consolidation before a breakout here. That's a consolidation and then the breakout. Consolidation, that's a big consolidation too, and then a major breakout. Miners are outperforming metals. As discussed in my book, gold divided by the CPI is a great indicator for gold mining sector. From chapter 8, the inflation adjusted gold price has a technical setup for an extremely significant breakout. Much like silver, this looks to be a 45-year breakout. This is a major catalyst for the reintroduction of gold stocks into the mainstream. So gold divided by consumer price index, you can see we had a big move in the 70s. We had a big consolidation of a cup and handle. We just recently broke out and everyone's still sleeping. This here should have been something that we should be looking at when we get to the right-hand side here, which we were, when we loaded up on the website, it was back over here. Your returns are like this. Year to date, 73% junior gold miners. Some of the companies are up way more than this. But that's what we have to look forward to. This is the BGMI. You can see the big up move here, the consolidation, and now we're starting to break through all that stuff. This is going to be fun. This is going to be fun. And that's all I've got for today. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. Specials that coupon code. And we'll catch you guys next time. See ya.